Well, let me now bring on board Keki Mistry and to talk about this real pivot which has happened in by Reserve Bank of India monetary policy, to talk about what the impact of inflation could be and when the impact of liquidity could be come back. I mean, Mr. Mistry needs no introduction. CEO of HDFC Life, independent director in several companies. I mean, we know him for the man who was part of that institutional team which has built a lovely franchise like HDFC. Keki, always a pleasure and delight to have you on ET Now. Let's first understand the impact of inflation in the overall scheme of things. And when do you see that the Reserve Bank of India liquidity impact will be visible in the real economic growth?
I think we've seen that inflation this month has come down very significantly. If you see the February number, which was released yesterday, it clearly shows that there is a substantive reduction in inflation. Now, given the reduction in inflation, my personal view, is that RBI may enhance or increase the rate cuts that we were earlier looking at. My sense was we would have looked at probably one rate cut in the next quarter, which would have been a 25 basis points cut. I still think it will be a 25 basis points cut, but I think the overall sentiment will be a lot better and a lot more easy on the part of RBI, because this inflation number has been lower than what they themselves were targeting.
Mistry, do you think low interest rates, or let me rephrase it this way, low inflation, is it a necessary condition for rates to come down, but is it a sufficient condition for a rate cut?
I think it is, because the economy also is not as buoyant as it was, let's say, 6 months ago. We've seen clearly some kind of a decline in economic growth. Consumption has also been relatively weak, against 8.2 or now a 9.2% GDP growth last year. This year we'll be having a significantly lower growth, still one of the best in the world, probably the best in the world for a big economy. But compared to where we were last year, there has been a slowdown. So my sense is RBI and the government will want the economy to start picking back up, which may mean faster rate cuts than what we were earlier envisaging. So there are two things. One is rate cut and the other is more liquidity in the system. And I think RBI will do both, ensure more liquidity in the system and come out with faster rate cuts than what was earlier anticipated. You see, the reason for economic growth is so important. It's not just a headline number. Economic growth will bring with it jobs. And I think for a country like us, job creation is the single most important priority that we need to have, because we have so many people who are passing out of business schools and colleges and schools every year. And we need to make sure that there are enough jobs available for these people.
Bringing rates down, Mr. Mistry, can it really kickstart the problem at a time when the world is staring at tariff, deglobalization? What interplay are we seeing? For example, the interplay we are seeing in manufacturing. Do you think those are larger trends at play? So interest rates and a loose monetary policy may not just be enough to stabilize things.
I think it's a combination of many things, but clearly interest rates have an effect on sentiment, and sentiment has an effect on investment, and investment will ultimately have an effect on job creation, which in turn will have an effect on consumption. So we have to start somewhere. I think liquidity was tight for a very long time. We've seen a lot of liquidity release in the system in the last, say, 6 to 7 weeks. We've seen an interest rate cut. We've seen a CRR cut. We've seen these OMO operations. And I think we will see more of that. My sense is that with lower interest rates and the sentiment will get better. If sentiment gets better, you will start seeing a pickup in production. If food prices remain low, you will start seeing a pickup in consumption in other items. And I'll come back to why I'm saying this. You will see consumption improvement in other items. And if that were to happen, you will start seeing manufacturing also coming with a lag. So these things all are not going to happen immediately. It's not that you will start seeing it next month or maybe even the month after that. But gradually over the period of the next 1 or 2 quarters, you will start seeing the economy bouncing back. And why I say that food is important is because for a lower middle income person, which is a reasonably large part of our population, the single biggest expenditure that the individual incurs is on food. So higher food prices for a large part of the year has meant that the individual has been able to save lesser and also spend lesser amount on consumption of other items. Now, if consumption slows down in the economy, then manufacturers don't want to create new facilities or new uh, manufacturing centers and stuff like that. And I think the budget has also helped because the budget has increased the minimum threshold level beyond which the individual has to pay taxes. 7 lakh has become 12 lakh. So that will leave more money in the hands of people. That coupled with better liquidity and lower interest rates will, over a period of a couple of quarters, start seeing a serious pickup in economic activity.
So, Mr. Mistry, where do you see a greater recovery coming in? The government is trying to normalize the economy by spending. The effect of interest rate and liquidity will come at a corporate level. And then the effect of interest rates and the tax saving cut, that is something which will kick back the discretionary spend. So, from a stock market standpoint, which is what we want to understand, which end of the economy do you think has the potential to bounce back the fastest?
Look, I think the stock market will see benefit all round. The banking sector will clearly see an improvement in margins because with lower interest rates and more liquidity in the system, cost of funds will come down. Lending rates may also come down, but cost of funds coming down will be a big benefit for them. The consumption sector, the retail sector should see a pickup in consumption. So the FMCG sector should clearly be a sector which should see a revival. FMCG, retail. Also, I think the IT sector should do well because we've seen a depreciation of the rupee, not because of anything to do with India, but more to do with global events. So you've seen a very sharp depreciation of other currencies. The rupee has depreciated relatively less than some of the other major currencies in the world. And to that extent, you have to compliment RBI and the government for the various measures that they've been taking over a period of time.
So logically speaking, sir, are we looking at like a 6.5 to 7% kind of in GDP growth in the second half of this year?
In my opinion, yes. I think you should see, well, not 6.5. I would be surprised if the growth is not 7 or very close to 7. I would certainly expect that in the second half of the year. And if we are lucky and the monsoons are good and food prices continue to remain low, there is no significant geopolitical uncertainty that comes up, then I would be reasonably confident that we can cross 7 in the latter part of the year.
So, Mr. Misri, there are a lot of moving parts in the financial space. There is one MFI space where there is problem. Rural NBFCs are under intense pressure. When do you see, and which pockets within the financial sector do you think will start normalizing first?
These pockets will normalize. See, rural economy had a bit of a, as I told you earlier, food inflation has an impact on the lower middle income people and it has an impact on the rural economy. So if good monsoons and the projection for monsoons or the expectation of monsoon in the current year is good, I would think the rural economy will start doing better, particularly in the period post June, July, August. So rural economy will do well. Microfinance, yes, has had its challenges. It may take some time for that to come back to normal, but other than microfinance and rural economy, by and large, the system is good. I don't think banks have seen any barring one or two which is very peculiar to that bank, any large bank or large NBFC has really seen any asset quality issues. In my view, the quality of assets that we have today in the banking system are far better in terms of quality, in terms of the way they are disclosed compared to where they've ever been historically.
So, Mr. Mistry, I'll take a little bit of liberty of extending my appointment with you with one final question. So one looks at the global big picture, tariff is a real threat. Change of supply chain, we've seen that in COVID, when supply chains were forced on us, how it impacted the global economy. What about global inflation? What about factors like currency? Don't you think those are larger themes which we need to really play on? Because that is a serious risk. I mean, what happens here in terms of interest rate, liquidity, all that really could become a sideshow.
It is definitely a risk to the world. And we are part of the world, and therefore it's a risk to us also. But the risk to India, and I keep repeating this, is far lesser than the risk to many other countries, like China, for example. we are so hugely dependent on the domestic economy. Our domestic economy is what is keeping us going. External economy, yes, it is there. If you look at exports are what, 22-23% of GDP. Exports to the US are 16-17% of our total exports. So in that sense, the proportion of the impact it will have on India will of course be there, but will be lesser than the impact that you will see on a China or on a Canada or any of these European countries. So yes, there is global uncertainty, but the global uncertainty is bad for everyone and less bad for us than it is for other countries. So relatively, we are better off because of the domestic economy. And I keep saying that the most important thing for us is to make sure that we are creating enough jobs for people who are passing out from schools and colleges every year.
Well, Mr. Mistry, appreciate your time. Thank you very much for joining us. And yes, sir.
If you like this video, then like, share and subscribe to ET Now.